Welcome to the deep dive. We're here to tackle complex information head on, sort of like navigating a supertanker through an ocean of data, and give you that shortcut to being really well informed.
Absolutely. And today, we're diving into ExxonMobil, specifically their latest reports, the Q2 and year-to-date numbers up to June 30, 2025.
That's right. We've got their SEC Form 10Q, the earnings release. It's a lot more than just dry numbers, isn't it?
Oh, definitely. These documents really paint a picture. Strategy, market shifts, huge investments, it's all in there.
So our mission today is to unpack the key details for you. We want you to walk away with a clear grasp of what's driving ExxonMobil's performance, where that massive capital is going.
And, what it all might mean for the wider energy world. It's quite the story.
It really is. So thinking about the big picture first,
hmm
what immediately jumps out at you from these reports?
Well, I think you have to start with the earnings, right? That's the headline figure,
Okay, let's unpack that then. Q2 2025 earnings, $7.1 billion.
which sounds huge, and it is, but it's down from $9.2 billion in the same quarter last year.
And that trend holds for the first half of the year, too. Year to date, $14.8 billion compared to $17.5 billion in the first half of 2024. So a definite decline.
Yeah.
What's behind that shift? What are the main reasons?
Well, it really underscores how much these global giants are still, subject to market forces. The biggest factors pushing those earnings down were lower crude oil prices and also weaker refining margins across the industry.
Okay, so market conditions mostly.
Primarily, yes. For their upstream business, that's exploration and production, those price and margin effects knocked off over $2 billion in Q2 earnings alone compared to last year.
Wow.
And chemical products fell too. Margins were weaker there, cost them about $560 million in Q2 earnings versus the prior year. It shows that offsetting that market volatility is, well, it's like a constant challenge.
Right. But despite that earnings dip, the cash flow story looks a bit different. Still seems pretty strong.
It does. Cash flow from operating activities was $11.5 billion for the quarter and $24.5 billion for the first 6 months. Pretty robust.
And they didn't hold back on returning cash to shareholders either.
Not at all. $9.2 billion returned in Q2. That breaks down into $4.3 billion in dividends and a hefty $5.2 billion in share repurchases.
And year to date.
$18.4 billion total distributions. So $8.6 billion in dividends and $9.8 billion in buybacks over the first half of the year.
And there's a really interesting detail linked to those buybacks, isn't there? Relating to the Pioneer acquisition.
Yes, exactly. And this is quite telling. Since they closed the Pioneer deal back in May 2024, they've already repurchased about 40% of the shares they originally issued for that acquisition.
40% already.
Yeah. I mean, that signals a very strong, very clear commitment to shareholder returns. It's like they're saying, look, earnings might fluctuate with the market, but we are prioritizing getting this capital back to you. It's a powerful message.
It certainly is. Okay, so we've got market prices as a major headwind. What else influenced the earnings picture comparing this year to last? It's never just one single factor, right?
Never. And there was actually a significant positive driver, too, what they call advantaged volume growth.
Ah, so producing more from their best assets.
Precisely. Upstream earnings actually got a boost from this, $160 million higher in Q2, and a really substantial $1.08 billion higher year-to-date because of volume growth.
And where's that growth coming from, mainly?
It's largely their key strategic areas. Think the Permian Basin, Guyana, plus, of course, the added volumes from acquiring Pioneer. So even with lower prices per barrel, producing more barrels from these efficient fields helped offset some of that impact.
Makes sense. Produce more where it costs less. What about the cost side of the equation? Any progress on savings?
Oh, absolutely. Structural cost savings were a big win. That added $310 million to earnings in Q2 and $620 million year-to-date.
And they've been working on this for a while, haven't they?
They have. They reported another $1.4 billion in savings just in the first 6 months of this year. That brings the total savings since 2019 to $13.5 billion. It's quite impressive.
$13.5 billion. Wow.
And they're not stopping. The goal is $18 billion in cumulative savings by the end of 2030. It's clearly a core pillar of their financial strategy.
$18 billion. That's a serious target. But it wasn't all savings, right? Expenses also played a role.
Yes, that's the other side. Higher expenses did dampen earnings somewhat. Things like increased depreciation, especially as new projects come online, and just the costs associated with growth initiatives.
Okay.
In Upstream, for example, higher expenses trimmed earnings by about $250 million in Q2.
Any other sort of financial adjustments affecting things?
Well, there were some timing effects. They had favorable impacts from derivatives mark-to-market adjustments, basically how their hedges are valued on paper at a point in time.
Right, the accounting value.
Exactly.
Yeah.
That added about $140 million in Q2 and $420 million year to date. It's more of an accounting timing thing than underlying operational cash flow, but it does impact the reported earnings number.
Okay, so if we pull all these different threads together, prices, volumes, costs, expenses, timing, what's the main takeaway on their performance right now?
I think it shows a company really in the midst of a dynamic balancing act. You've got strong internal performance drivers, that volume growth from key assets, those significant cost savings, real strengths.
Right.
But they're pushing against external headwinds, mainly those weaker commodity prices, especially for crude and chemicals. And at the same time, they're investing heavily, which also increases near-term expenses like depreciation.
So, internal resilience versus external pressures and investment spend.
That sums it up pretty well, I think. It's a story of leveraging their strengths while navigating a challenging market and funding future growth.
Fascinating dynamics. Let's maybe zoom in a bit now on the specific business segments. That's where you really see the action on the ground. How did upstream exploration and production, how did that segment perform operationally?
Operationally, Upstream had a, frankly, stellar quarter. Net production hit over 4.6 million oil equivalent barrels per day.
4.6 million. How does that compare historically?
It's their highest second quarter production level since the Exxon and Mobil merger. So we're talking over 25 years ago.
That's huge.
It is. And year-to-date, production is up 13%, or about 520,000 barrels per day compared to last year. Again, driven mostly by Pioneer and the Permian, where they hit a record 1.6 million barrels per day in Q2.
So the acquisitions and core asset growth are really delivering volume.
Definitely. They did sell off some smaller, non-strategic assets, but the impact of those divestments was pretty minor compared to the overall growth surge.
Okay, let's switch over to energy products. That's their refining and marketing arm. What was the story there in Q2?
Energy products saw a nice bounce back in earnings compared to the first quarter. The main reason was stronger refining margins across the industry.
Why the stronger margins?
Mostly seasonal demand picking up, as you'd expect moving into the summer driving season. Plus, there was less planned maintenance downtime industry-wide compared to Q1.
Makes sense. And any major operational updates in refining?
Yes, a couple of significant project startups. The new Foley hydrofiner in the UK began its startup process. That's designed to make an extra 37,000 barrels per day of ultra-low sulfur diesel.
Meeting tighter fuel standards, presumably.
Exactly. And also, the Strathcona Renewable Diesel Project in Canada started up. That's Canada's largest renewable diesel facility, adding 20,000 barrels per day of capacity.
Interesting. So investments in both traditional refining upgrades and renewables.
Right. It shows they're playing in both spaces, trying to meet current demand while also building out lower emission fuel capacity.
Okay, how about chemical products? You mentioned margins were weak there earlier.
Yeah, chemicals had a tougher first half overall. Year-to-date earnings were down significantly compared to last year. It really was mainly those weaker industry margins, plus higher expenses tied to getting their huge new China chemical complex fully up and running.
That complex is starting to contribute now.
Yes, that's the upside. Sales volumes in Q2 actually increased because that China complex is ramping up production. So the investment is starting to deliver volume, even if the margin environment remains challenging for the whole sector right now.
Got it. And finally, specialty products. What's happening there?
Specialty products continue to perform well. It's a segment focused on higher value materials like lubricants and advanced plastics.
And then they maintain strong earnings.
They did, helped by better margins, especially for finished lubricants, and also lower costs for base stocks, the raw materials for lubes.
Any big projects starting up there too?
Yes, the Singapore Resid Upgrade Project began its startup phase. This is a big one. It aims to take about 80,000 barrels per day of low-value fuel oil and convert it into higher-value products.
Like more lubricant base stocks?
Exactly. Performance lubricant base stocks and also distillates like diesel. It's all about upgrading the value of each barrel.
Makes sense. Any other drivers in specialty?
They did mention higher expenses related to investments in things called Proxima Systems. That seems to be advanced tech for developing new materials and also efforts to grow their presence in the carbon materials market. Things specialize carbon products for batteries or lightweight composites, so investing in future growth areas there too.
Okay, so we've seen the operational side, the investments, the market impacts. Let's pivot back to the overall financial health. What does ExxonMobil's balance sheet look like right now, as of June 30th?
It looks very solid. Total assets are sitting at around $447.6 billion,
And liabilities.
about $177.6 billion, giving total equity at $270 billion.
What about debt levels? That's always a key metric.
That's actually a strong point. Long-term debt decreased. It stood at $33.6 billion at the end of Q2, down from $36.8 billion at the end of 2024.
So they paid down some debt even with the Pioneer acquisition closing relatively recently.
Well, the Pioneer deal involved issuing shares, not just taking on debt, but yes, the overall long-term debt figure is down. This helped improve their debt-to-total capital ratio. It's now 12.6%, down from 13.4% 6 months earlier. That's a pretty conservative leverage level for a company this size. Reflects a strong balance sheet.
Very strong. And what about the pace of investment? You mentioned projects starting up. What are the capital expenditure numbers telling us?
They're definitely still investing significantly. Cash capital expenditures, actual cash spent, was $6.3 billion in Q2.
And for the first half.
$12.3 billion for the first 6 months of 2025.
And their plan for the full year.
They're guiding for total investment in the range of $27 billion to $29 billion for 2025. So yes, a continued high level of investment focused on those high return advantaged assets and projects we talked about earlier.
And do they have the financial flexibility, the liquidity to handle all this and any surprises?
Seems so. They report having access to significant liquidity, both long-term and short-term. They expect their own operations to generate most of the cash they need, using debt mainly as a supplement.
Any specifics on credit lines?
Yeah, at the end of Q2, they had, about $0.2 billion in undrawn short-term credit and $0.7 billion in undrawn long-term credit lines available. So yes, plenty of financial flexibility there.
Okay. Now, no discussion of a company like ExxonMobil is complete without touching on the legal and regulatory side. Anything major happening there? You hear about climate change-related lawsuits, for example.
That's right. They are involved in several legal proceedings. Some are these novel claims being brought by state and local governments related to climate change impacts. There are also lawsuits down in Louisiana concerning coastal marsh erosion.
And what's ExxonMobil's position on those?
Their stated position is that these claims lack merit. They view them as attempts to use the courts to drive policy changes, which they argue isn't the appropriate venue. They believe the chances of these suits having a material adverse effect on the company are remote.
So they're fighting them but don't see them as a major financial threat currently.
That appears to be their assessment, yes.
Was there anything else specific on the legal front recently, maybe related to environmental compliance?
Yes, there was a penalty finalized in June, $14.25 million related to alleged Clean Air Act violations at their complex in Baytown, Texas. They've indicated that penalty will be paid.
Okay. So looking forward then, wrapping things up, how does ExxonMobil frame its strategy going ahead? What's the emphasis?
The emphasis is very clearly on what they term advantaged assets and advantaged projects.
Meaning
Assets like the Permian, Guyana, their LNG ventures, places where they have low costs or high growth potential. And projects that integrate different parts of their business or produce higher value products or just offer superior financial returns. It's about focusing investment where they feel they have a distinct edge.
And the cost savings continue to be a big part of that.
Huge part. That 2030 structural cost savings plan is central. They aim to outperform competitors on efficiency. And they expect that these savings, combined with new projects coming online, will boost their earnings power by over $3 billion in 2026 alone.
So a very disciplined focus on maximizing value from core strengths and driving efficiency.
Exactly. That seems to be the core message in their forward-looking statements.
Well, we've certainly covered a lot of ground here, a real deep dive into ExxonMobil's recent performance and strategic direction. We've seen how they're navigating those market swings.
Yeah, really focusing on those high-value areas, investing heavily, but also squeezing out those structural cost savings. It's quite the combination.
They've definitely shown resilience, leaning on their most productive assets and that efficiency drive, even when, prices weren't cooperating fully.
And that commitment to shareholder returns, the dividends, the big buybacks, that definitely sends a strong signal about their confidence and where their priorities lie, even amidst all this investment.
It really does. So, thinking about everything we've discussed, the sheer scale of this company, the commitment to shareholder returns, these huge ongoing investments in both their traditional energy base and these newer, lower emission solutions. It does make you wonder, doesn't it?
It raises a big question, yeah.
How might this dual strategy, maximizing the value of today's advantaged assets while simultaneously investing in potentially new energy solutions for tomorrow? How might that reshape their role in the whole global energy transition over, say, the next decade?
Hmm. That's the multi-billion-dollar question, isn't it? What impact will these choices have? Not just on their own bottom line, which is obviously key for them, but on the broader energy landscape and ultimately, our collective future.
Yeah, exactly. Yeah. Something for all of us to think about. Yeah.